What is price action? How are candles formed on the chart? And what is the mindset or psychology of buyers and sellers behind them? Let's know this in detail from basic to advanced. First of all, what is price action? Let's know. This is the chart of Nifty 50 of 2nd February's 5-minute time frame. Here the market opens at 21,800 level and moves up with a strong green bullish candle. After that, for the next 2 hours, the price trades in the same range while facing resistance at 21,950 level. But after 11 o'clock, the price breaks this range and moves up. The price forms a base here after a strong movement. And after the breakout, it again continues its old momentum. Here, the price moves from one point to another. Whenever the price has to move in a direction, the price never moves in a straight line. To move the price forward, it is necessary to have buyers and sellers in the market. That is why the price, while moving forward, forms a formation of higher losses and lower highs, due to which buyers and sellers keep entering and exiting the market at different levels. This movement or action of price is called price action in the language of trading. Now we will learn how candles are formed and what is the psychology behind them. This is the chart of Nifty 50 of 5 February of 5-minute time frame. Here the market opens at 21,900 level, and while forming the price action, 21,960 faces resistance from this level. If you look at the chart carefully, here the price is facing resistance again and again from 21,950 to 21,960 from this level. This implies that whenever the price reaches this zone, sellers initiate new selling and drive the price lower. If we draw a trend line connecting today's days, whenever the price reaches this trend line, buyers come into the market and elevate the price. In this scenario, the stop loss for sellers is located in this upper area, while the majority of buyers have their stop loss positioned below this support level. What this indicates is that these two levels hold significant psychological importance in the market at this moment. The reason is that whenever the market attempts to breach these levels, the psychological state of either the buyers or sellers will be disrupted. As a result, they will experience panic and begin to exit their positions hastily. Last time, when buyers tried to push the price up, as the price comes near the resistance level, the size of the candles becomes smaller due to the decreasing number of buyers, due to which the price is unable to break the recent swing high. This means that this was the last attempt of the buyers to push the price up. Seeing the low-lying pressure, the sellers again push the price down, due to which a strong red candle breaks the trend line and closes down. Here some buyers get scared after seeing the trend line breaking and start exiting the trade. So some new traders notice the support line and buy at lower levels, causing the price to rise again. However, due to strong selling pressure, the price doesn't hold this level for long and drops sharply. On this hammer-type candle, large institutional sellers enter the market one last time, causing the price to fall rapidly, forming large red candles. Here you have to understand the psychology of the market behind this breakdown. If you carefully observe the price movement from 10 a.m. in the morning till this breakdown point, here, whenever the price moves upwards, small green candles are formed. But whenever the price comes down, it comes down by forming big red candles. This means that, in the market, sellers are actively selling as compared to buyers, and they are more interested in keeping the price below the resistance level. Any big institutional sellers cannot place their sale orders at any one level at the same time because they trade in very large quantity, so they need liquidity in the market to execute their selling orders. For this reason, to create liquidity in the market, the price is repeatedly pushed upwards so that more and more retail traders buy in the hope of resistance breakout, and the sale orders of these big institutional sellers are executed slowly. As soon as the buying interest of retail traders decreases, these big sellers start selling from the top and bring the price down. The operators in the market have deliberately pushed the price near this resistance level again and again. And they want the retail traders to feel that the breakout of this resistance is going to happen, due to which some retail traders become impatient and get tempted and start making their trade entries even before the breakout of the level. They feel if they don't enter, they'll miss the trade opportunity. Traders in this zone develop FOMO, fear of missing out, and they are not able to control this mindset. Similarly, big traders play with the mindset of retail traders and trap them in their net by luring them. While trading in the market, you have to understand the tricks of these institutional traders, which we call smart money concepts. Only then you can become a profitable trader. By looking at the price action in this chart, you have to always keep some important points in mind. First point, whenever the market trades in a consolidation zone or trades in a range, break out of the range, or the breakout of the range. Second point, what do you think is more visible on the chart than this? The trade entry should be based on that. Third point, do not enter a trade against the trend by looking at just one candle. For instance, if you try to take a long trade by looking at this single green bullish candle, your chances of loss are quite high. Fourth point, whenever there is a break of any significant psychological level, such as a trend line or support and resistance, then unless that level is broken by a strong breakout candle, wait for a continuation candle before entering the full trade. Fifth point, when you are analyzing the price action in the market, it's crucial not to make a decision to buy or sell just by looking at a few candles. It is essential to first understand what the overall major trend of the market is. Only after doing this, you will be able to make the correct trade entry. If you enjoyed watching our video, we kindly ask you to like the video and subscribe to our channel. We appreciate your